Today we're going to be talking about cover calls, and we're going to be analyzing a cover calls risk profile. And this is the first strategy that we're going to be taking a look at, where we are combining stock and options. So this is a very important strategy for you to know and to use, because it's one of the most widely used as well. A cover call is made up of long stock and a short call. Usually the short call is established out of the money. It's important to notice that the quantity should match between the stock and the short call. So if you have 100 shares of stock, long stock, then you should be selling only one call contract. This strategy is bullish to neutral, because what's happening here is that the stock is trading right here. We're selling this call at this point, and we're giving up all of this area in terms of profit, because the dotted line here, you can see this is the stock. So if you didn't sell the call, you'd be making a lot of money here. But instead of that, you are getting some premium in a similar way to what the insurance companies do. And because of this, you are giving up the profits from in this area in exchange for premium that you're going to get from selling this call. The loss can be substantial, all the way down to zero. So a lot of people mistakenly believe that this is a very safe trade. In reality, this trade is completely exposed on the downside. So you're buying stock, you're selling a call, but if your stock starts going down, there's nothing preventing you from absorbing all these losses in here. So it's important to notice here that you're completely exposed on the downside. Once you have the stock, there is no extra BPR for the short call. It's only for the long stock, because your cover is a cover position. There is no extra BPR, buying power reduction. This is what we were mentioning. You are giving up all the profits beyond the strike price in exchange for premium. However, once you hit your strike price, of course, you already have some profits. The only thing that you're doing is you're giving up the extra profits that would have come with holding the stock. This strategy is used a lot by fund managers, because if the price doesn't move, and if the price of a certain underlying, of a certain stock doesn't appreciate, then this is a way to extract or to start getting some sort of a dividend out of their existing holdings. The risk, of course, is that if it does start appreciating, then the profits from that position are capped. So in exchange for that premium, they are giving up the profits that come with a large up move. But in exchange for that, also with that premium, you are protecting yourself a little bit to the downside. However, if there is a substantial violent move to the downside, then you're completely exposed, other than the premium that you got. Another thing to notice is that the premium is higher when the implied volatility is high. Why is this? Because the price of the call that you're going to be getting, so the premium is going to be higher, is directly proportional to the level of implied volatility. So this strategy should be deployed ideally when there is an environment with high volatility. Now, some fund managers, what they do is they don't necessarily know all these details. All they know is that they make some money by selling calls, selling upside calls. And when the volatility is low, the premium is very low, and they're not being compensated proportionally to the risk that they're taking. In most platforms, a cover call is a single transaction. So you don't need to buy the stock and then sell the calls for this particular strategy to be in your account. You can do it directly through a single transaction, where you select the call that you want to sell, and automatically you're going to be selling the equivalent quantity for the stock that you need for your cover call. A cover call can be thought of as buying stock at a discount as well, because let's say, for example, we're gonna look at an example just now, but if you have a stock here and it's trading for $100 and you get $5 because of your call, because you're selling the call, then you're only paying $95 for a stock that's trading at $5. Of course, you are giving up any profit beyond your strike price, but it can be thought of a little bit as acquiring stock at a discount. Now let's analyze the price at expiration. What happens in the different areas? So as you can see here, the red area is the area where you're going to have losses, and the green area is the one where you're going to be profitable. Now there's a huge profitable area, but keep in mind that from this point and higher prices, your profits are capped. They're not growing with the underlying price. So just keep that in mind, because even though it looks as if it's a huge profitable area, in reality, you are going to have profits here, but they're capped. So when the stock price expires below the break even, you're going to have a loss. Your profit and loss at expiration is going to be the expiration price minus the initial price when you establish the position, plus the premium. You always get the premium. The premium you get to keep. If the stock price is right at the break even, then you're not going to have any profit or loss. If your stock price is between the break even and the strike price, so in this area, then you're going to have a profit which is going to be equal to the expiration price minus the initial price plus the premium. So in this area, your profits are going to start growing with the actual underlying price until you hit the strike price, because at that point you are committed to selling your stock. So the called buyer is going to be able to call your stock away. So when the stock price ends up at or above the strike price, then you're going to have a profit which is going to be equal to the strike price minus the initial price plus the premium. Now notice here, it's not the expiration price anymore. It is the strike price. So it doesn't matter how high it goes. You're only going to be making this money no matter how high it goes. This is what you're giving up in exchange for the premium that you get when you sell your call. Now finally, just as this is more of an advanced concept and something that you're going to be looking at when you start looking at put-call parity and some advanced concepts in terms of option trading. What you're going to see here is that a cover call is exactly the same, and it behaves exactly the same as a short put. So those two positions are equivalent. They're synthetically the same. There's only minor differences when you think of a short put versus a cover call, but they're basically the same. Another thing that I didn't have here but that is important is when you have a cover call, because you have long stock, if there is a dividend in between, then you're going to be receiving the dividend. So, which is something that's different than if you had a short put. So, as part of the analysis of a cover call, you have to consider if there's any dividend, because if you're a long stock, and it doesn't matter that you have a short call, if it's not exercised and you are on the ex-dividend date, then you're going to receive that dividend. So that could be an additional source of income for those positions, and that is the reason why many fund managers choose to use this strategy, because not only do you get a premium, but you also get dividends if there are any. So here we have the actual position, the cover call, and what we have is the structure is long 100 shares of the underlying at the money, so you buy them the price they're trading at, and short one call contract at the strike price, KC in this case. I called it KC. Okay, the break even is going to be where the stock is, which is the at the money, minus whatever you got for the call. So minus the premium that you received for the call, ATM minus C. This is going to be the break even. The max loss is going to be the same as the break even, because once you get here, there is nothing stopping you from losing money if the stock starts going down, and it could potentially and theoretically hit zero. So the max loss is the stock price, or the at the money, minus the amount that you got for the call, the premium. The max profit would be the strike price that you have here minus the price of the stock when you initiated it, which is the at the money, plus the premium that you got for the call. So basically, the max profit is this distance that you can grow in terms of price and capture the profits, plus the premium that you got from the beginning when you put the position on. Okay, so that's going to be your max profit. The call strike minus the initial price of the underlying plus the premium that you got for the call. And this is a representation of the profit at expiration, the profit at a time prior to expiration, and this dotted line, it's representing the stock. This is what the stock would make if you were long the stock.